Thank you, everyone, for joining Darien Library this beautiful Monday evening for Tax-Free and Retirement with Michael Alimo. Sorry, I'm getting distracted because I have to admit people into the waiting room. Michael Alimo, investment advisor representative. He began his career 30 years ago working from various Wall Street brokerage houses. And for the last 18 years, he's been devoted to serving clientele around Connecticut and New England at his USA Financial and Tax Services, LLC. Before we begin, I'd like to mention that programs at Darien Library are made possible by the annual Friends of the Library campaign. We thank you for your support to make programs like this, as well as our collections available to the community. I want to let you know that if you have any questions this evening, please hold them to the end and put them in the chat, and then Michael will get to them later on. Now I'm going to pass the mic over to Michael. Thank you.
Hey, thank you, Amanda. And thank you to the Darien Library, certainly for allowing us to present this topic to you tonight. As someone had just mentioned, taxes can be a four-letter word sometimes, so I'm going to give you a lot of details. Some of it in the beginning is a little bit dense because of some tax code and tax laws, and then we'll get into the topic a little bit more in depth with presentations as well. And I'll tell you a little bit about myself as we get going here. Okay, so let's just start with the topic tonight, tax-free retirement and potential upcoming tax changes and how they affect your retirement. As Amanda had mentioned, USA Financial and Tax Services is the name of the company. A little bit about my company itself. When I started this company about 20 years ago, my background, as Amanda had mentioned, was on Wall Street. And then I worked with some of the larger brokerage firms, learning what we call the retail trade or the consumer trade. When I built this company, it was to be different than traditional financial advisors, and I'll show you what we have in common and where we differ. We have a wealth and money management division, and this is obviously a very common concept for financial advisors, is typically how they get paid. We also have a division for retirement and income planning, estate and legacy planning, tax planning and tax preparation, which you'll learn about tonight, insurance strategies, and insurance planning. We have offices in Glastonbury, New Haven, Bridgeport, Danbury, and Wilton as well. So how do taxes impact your retirement? One of my more favorite sayings here, and one of the core principles of investing, is whether to save for retirement or to generate cash is to minimize taxes. Strategic allocation from a tax perspective should give your accounts the best opportunity to grow over time. So remember, it's not what you make, but what you keep. And so briefly here, this is an educational workshop, and it is presented for general information purposes only, and it is not intended as recommendation or investment advice for any individual or the specific need on the call. We strive to offer factual, insightful, and up-to-date information on the subjects we're going to discuss, while providing the public a sound basis for evaluating the facts regarding this information. Please, the examples within this presentation are for illustration purposes only, and we certainly suggest you consult your own financial professional if you have one and make the appropriate decisions based on your own circumstances. Reason for the disclaimer here, folks, is I don't know anyone on the call, and depending on your financial situation, the strategies may be different for everyone on the call. So our company vision for our clients: when was the last time these four persons got together and coordinated on your behalf? And again, that would be the estate planner, the insurance agent, the financial planner, and the accountant. And my attitude on this is, shouldn't they? Because they're all involved in important monetary decisions on your behalf. So let's break down each one briefly. An estate planner is dealing with your money matters today, building your estate plan, and someday when you pass on a legacy, if you're fortunate enough, to your heirs. So obviously dealing with money. An insurance agent is notorious for selling you policies, obviously focused on a dollar amount, such as life insurance, long-term care, annuities, or even disability insurance, so monetary. Financial advisor, we went over that one, eager to manage your money and grow your wealth. And then the accountant typically has the least advantageous position.
I got it.
Amanda, do you hear that feedback?
You're all set.
Okay, thanks. And so the CPA or the accountant, the least advantageous position, because most of you at this point this year have handed in your paperwork, but that's from last year. And so that picture really can't be changed much. As tax planners, we're trying to change your tax picture going forward. And so I call this concept the full circle advisor approach, where we're integrating these 4 different facets into one company. One last thing, we do practice what is called the fiduciary standard, and this is where we're, by the regulators, Security and Exchange Commission and state insurance regulators, hold investment advisors to what is called a fiduciary standard. Some of the examples here, an advisor must place his or her interest below that of the client. The advisor must do his or her best to make sure the investment advice is made using accurate and complete information, and the analysis has to be very thorough. And lastly, the advisor must avoid conflicts of interest, and as a fiduciary, the advisor must disclose any conflicts of interest or potential conflicts of interest. So what does your advisor practice? Okay, so now we can, we're done with the housekeeping here, and we can get into the presentation. I'm going to urge you to take notes, write down questions. I will mention this now to Amanda. I know she's still on the call. Because we're doing this virtually, I'm happy to send out our packets or our handouts that we normally give at the presentation in person down to the Darien Library. So anyone who would like to get a handout from the presentation, I will leave them with Amanda down at the Darien Library. And you'll be given an opportunity to reach out to me whether you'd like to take advantage of any of the items that we offer in the presentation. So for tonight's agenda, we're going to talk a little bit about the history of taxes and your retirement, some recent tax changes, some of the proposed tax changes, and that's kind of all over the board right now, tax-free legacy concepts, and tax-free conversion strategies. And so to back it up a little bit here, the way I've always started this presentation is I've asked people, who's tired of paying taxes? Who wants a tax-free retirement? And then ultimately, my question to you is, what are you waiting for? You're going to find out tonight that a lot of this is in your control, but it's going to take embracing this concept here. And we call this the tax bridge. And so in theory, this is a very long bridge, and you're going to all have to cross it and pay the taxes. The question is, when do you cross the bridge? You may want to choose this, as you'll learn tonight in the presentation. So we're going to refer back to the tax bridge quite a bit. First and foremost, everyone has been talking about this. The question is, have you been listening to it? I wish I could have coined this phrase myself, but it's been out there some time. And so here's Forbes that talks about 5 legal ways to get tax-free income for retirement. And I'm glad they put the legal part in there. Here's CNBC that talks about 3 tips to help you boost your tax-free income in retirement. Here comes the Wall Street Journal that says how to get entirely tax-free retirement income. And lastly, this was TurboTax that talked about the golden years to a tax-free retirement. So again, this concept in bits and pieces has been out there, and putting it together is really the big part of it. So a question for you, and certainly I do wish I can ask you this in person. I usually get the answer right out of the gate, and I ask people, will taxes go higher or lower in the future? Most people feel higher, and let's try to build a case for that scenario. So we're going to take a look at some troubling statistics here. And so this is an interesting site. This site is called usdebtclock.org, and I always equate this, kind of showing my age here a little bit, to the old electric meters that were on the side of homes, and you'd see the dials spinning all the time. And what's happening with our national debt is it just continues to climb. This was about a month ago. I think we have now topped $28 trillion. And so this is something at some point we do have to chip away at as a nation, whether it get paid off or we reduce it, we do have to work on this. And you'll see that the average debt per taxpayer is almost $250,000 now. And that's how they get to the $28 trillion. But more interestingly, I talk about balancing a budget, whether it be your household budget or the U.S. government budget. Now, obviously, the U.S. government has many challenges and many things to pay for, but you'll see the tax revenue here of the U.S. Government is about $3.5 trillion, and you'll notice the spending officially is about $6.6 trillion, which leaves us a deficit of almost $3.2 trillion. And again, to keep it in simplistic terms, could we do this in our own household? Could we make $100,000 a year and continually spend $150,000? And the answer is no. And this is one of the challenges going on in the country right now on the money side. A quick federal tax quiz for you here. Highest tax bracket ever in the history of the country, 1950 to 1963. 92%. Now, to be fair, back then you did have to make over $450,000, but if you did, anything above that was taxed at 92%. So in essence, you lost all of that income. As recently as the 70s and 80s, you'll see the tax bracket here was 70% at that highest progressive level. So very little take home here. And currently, till 2025 or beyond or sooner, the current highest tax bracket is 37%. So I know a lot of people on the call do feel like they're paying a lot in taxes, but on the federal tax level, I assure you, taxes are really not that high. And this is something that you have to embrace for the conversation tonight. Now, one of the jobs I had on Wall Street is I did a chart analysis, and we would study price patterns and charts. And all this is a 65-year history of taxes, federal taxes here. And you'll see that 92% that I talked about there in the early 50s. And you'll also see the 70% or so there in the 70s. More importantly, you'll notice on this chart that 37% over a 65-year period is actually very low. So our federal taxes are actually very low. And the median average for this chart is actually 58%. So you have to start thinking, what would happen to your money if most of it is tax deferred and the taxes go higher? Now, to compound a little bit of this situation, we talk about the solvency of Medicare and Social Security. I'm going to mention briefly here, but a lot of people, for some reason, leave out the conversation on Medicare. And you'll see here, according to the Medicare Trustees Report, that in essence, Medicare Hospital Insurance Trust Fund will be bankrupt in 2026. And while the bankruptcy projection may snag the headlines, there are other key budgetary numbers that shouldn't go unnoticed. So what would happen to this country if we didn't have Medicare? Obviously very detrimental. So I do believe that there will be some fixes, but what is the long-term problem? The short-term problem, 34% of Medicare contributes to the national debt. $5.5 trillion is the shortfall since 1965. And we're short in 2019, almost $400 billion. So this is also adding to our national debt. The solvency of Social Security, I've given hundreds of classes on Social Security. And the interesting thing here, and some of the good news on Social Security is Social Security is not going broke. However, the Board of Trustees of Social Security do project that there will be a shortfall in 2035. And in essence, they will only be able to pay about 75% of the scheduled benefits. A lot of people don't realize that Social Security is made up of two funds. One, again, is that excess trust fund, kind of like Medicare, and the other one is ongoing payroll taxes. And if that trust fund depletes by 2035, you should get about 75% of your scheduled benefits. The reason Social Security shouldn't go broke is because it's the ongoing payroll taxes that continue to contribute to it. So I always thank my kids facetiously to say, hey, I'm going to get a Social Security benefit because you're working. But again, another monetary issue in the country, Social Security and Medicare. Now, if you remember, we talked about this earlier. The highest tax rate was 92% in that period of 1946 as well as 1953. And at that point, we had a debt to gross domestic product of 106%. And you'll see as of 2019, we were at 106.9%. So my correlation here is to help you understand high debt to GDP, back then 92% tax rate, currently 37% tax rate. So if I were fortunate enough to be sitting in front of you, the folks who said you thought taxes would go lower, I would question that, but I would certainly listen to why you might say that. Now let's go over a little bit of tax regulation. This portion of the presentation takes about 10 minutes and it is relatively dense. Some of this you probably know, some of it may be new to you. This is the Tax Cut and Jobs Act of December 2017, which cost the government an estimated $1.9 trillion. What they did here is they had standard deductions doubled. So most of you notice if you look at your tax return that you're probably not itemizing deductions any longer. And here's one of the reasons. You'll see that state and local tax deductions called the SALT tax have now been capped at $10,000. If you live in the region, obviously $10,000 in property taxes is nothing. 7 tax brackets remain, but they were all lowered. And the personal exemptions were taken away because they doubled the standard deductions. Some additional items to that act, they lowered the corporate tax rate from 35 to 21%, and they created a 20% deduction for pass-through entities on qualified business income such as LLCs. You did have to qualify based on the type of business and the amount of income. This one here we used to have some fun with, but if you got divorced after 12/31 of 2018, you can no longer deduct the alimony, which was a big deduction for people who were paying it. And new mortgage interest deductions are capped at a $750,000 mortgage. Now, along came the Secure Act of December 2019, and in dollar-wise, only $16 billion here, so a real minimal effect in terms of the budgetary concerns. But you'll notice here a couple of things. To me, this was the most interesting thing that they did in here. And a lot of people seem to be aware of this. They raised the required minimum distribution from 70.5 to age 72. So in essence, I call this the carrot before the horse. They're telling us we have an additional 18 months before we have to take required minimum distribution, which on the surface you may believe is a good thing. Now, inherited IRAs from the original owner who have passed away on or after January 1st, 2020, require many of the beneficiaries to withdraw assets from the inherited IRA over a 10-year period, but no later than 10 years. So my analogy on this is they gave me an additional 18 months when I'm required to take distributions, but now, unless there's certain circumstances, my beneficiaries will have to take it all within the 10-year period. So the concept of stretching out an IRA doesn't really exist any longer. Now, the exceptions to that 10-year rule were leaving assets to a surviving spouse, but obviously that spouse would eventually leave it on to secondary beneficiaries, a minor child, a disabled or chronically ill beneficiary, and beneficiaries who are less than 10 years younger than the original IRA owner or 401k participant. So in essence, the big one here was giving us an additional 18 months to take required minimum distributions from our retirement accounts, but giving our beneficiaries only up to 10 years to take the money out, which in my opinion will create a tremendous tax windfall as the baby boomers start leaving the earth. Now, along came the American Rescue Stimulus Plan of March 11, 2021. So this one is pretty new, and most of you probably know this. There were more stimulus checks that were sent out there, 1,400 and 2,800. There were some earnings limitations to it. They also offered some child tax credits, which should start July of this year. There was additional aids to the state and cities, which was important, and additional aid to the unemployment. Aid to businesses, more of the PPP loans where businesses were able to get loans that would be forgiven as long as they maintained their payroll and did not cut people off a payroll, and then some aids to schools as well. So another very expensive plan. Now, what are some of the possible upcoming changes? And this has been a big part. I apologize, it looks like one is out of sequence here. This has been a big part of conversation, and I would caution you here, this is all what I'm reading about on various tax sites and investment advisory sites. None of them are set in stone, and I think they're really just negotiating points at this point. One of the first things that are being considered, removed preferential rates for qualified dividends and long-term capital gains for taxpayers with income over $1 million. So obviously very substantial, but a good starting point if you wanted to increase taxes, and increase the top tax rate for individuals from that 37% to 39.6% for income over 400,000. This one I found very, very interesting, and I do believe something like this will take place. Bernie Sanders introduced a bill called the 99.5% Act, and it includes federal estate tax rates to increase to 45% from the current 39% for estates over 3.5 million. Now, if you understand the federal estate tax, right now it is 11.7 million with the portability of a spouse. So in essence, a couple could have almost $23.5 million, substantial assets, and avoid federal estate taxes. There's talk here to bringing it down to $3.5 million and starting the tax at 45%, and potentially going high as 65% for estates over $1 billion. So something to keep an eye on if you do have considered high net worth. What happens to the federal estate taxes? Because starting at 45% is taking almost half of your money, and then what will the state itself do beyond that? Connecticut is one of the handful of states that's still tax estates. Another thing they're looking into is expanding the taxes on earnings above $400,000 into Social Security. So in essence, they would be this donut hole. Right now, you don't pay into Social Security for any earned income above $142,800. So they want to leave this $142,800 to $400,000 alone, but then if you're still earning above $400,000, continue to tax you on Social Security. From what I read, that will not increase your Social Security benefit in the future, but it will put more money into that Social Security trust fund, as I had mentioned. There's also been talk, and I don't see the likelihood of this, at least not now, but in the midterm elections, it's dependent on the elections themselves. The president has mentioned that he would potentially consider repealing the whole Tax Cut and Jobs Act that we reviewed of 2017. The challenge with that and any tax law is you do need, it is a law, so you have to pass the House, the Senate, and the presidency would have to sign off. But there's also talk about repealing the whole tax law of 2017. In addition, this has been out there quite a bit. There's a lot of talk about raising the corporate tax income rate from 21% to potentially 28% from the previous 35%. And then the transfer tax is also very interesting here. And to give you an idea of this proposed transfer tax here, it would tax certain amounts of unrealized gains received by heirs when they receive assets at death. It provides for modification or the substantial elimination of what's called the stepped-up basis rule. $1 million of assets would continue to receive a stepped-up basis, plus up to $500,000 for personal residence. The legislation allows for taxpayers to pay the tax of installments over 15 years. Stepped-up basis, most people are familiar with the concept when it comes to stock. So if I bought stock for $10,000 and it appreciated to $100,000, and this is non-IRA money, and I leave it to my kids as an example, they would inherit it at that $100,000, and pay no taxes if they sold it at that time. If they waited it for it to appreciate to, let's say, 110,000 after my death, they would pay the taxes on that 10,000 in gains. There's talk about changing that, and that would have a dramatic impact on people holding stocks in the long term in the stock market, as well as real estate. One last thing, they're talking about modifying trust. So if you have a trust where you're generating income from, they're talking about taking a look at the amount of income that the trust generates and, in essence, changing the tax rate on those as well. A lot of wealthy people have put money into trust for preservation of the asset while still utilizing the income. In this concept here, they would go after taxing the income of the trust. So a few things to watch out there. One last thing, you want to keep an eye out on the state as well. I did talk quite a bit about the federal government, what's happening on the state level. Here's a short excerpt from the Yankee Institute, Connecticut here. Study shows unintended consequences for Connecticut income tax increases. New York, Governor Cuomo has talked quite a bit about this, about raising taxes for millionaires while other states follow. And lastly, New Jersey talks about fiscal year 2021 budget enacted with tax increases. The states are much more creative on the tax front, whether it be a car tax, a gas tax, tolls. So the state does have a lot more creativity when it comes to taxing, but please don't forget about the potential of increases on the state level. Now let's talk about the progressive tax system and the old versus the new, and potentially where some of these opportunities might be. Now you'll see this is an older chart from 2016, and I'm going to focus on married filing jointly, but you do see the single and the head of household there. Now, if you understand our progressive system, every time you make a batch of money, it gets taxed at different levels. So in the old system, from 0 to 18,550 was 10%, 18,551 to 75,3 was 15, and on and on and on, all the way up to that 466,951 in the center column. Now you'll see our tax rate was 10, 15, 25, 28, 33, and so on. What happened with the changes? We'll see here that those numbers, other than the 10% bracket, were lowered by about 3 or 4% to 12, 22, 24, and 32. So in essence, taxes were put on sale. I don't believe many of you feel that way because most people, when they went to standardized deductions, didn't really see much of a difference in their tax return. In fact, some people wound up paying more. But these numbers were lowered, and they're good until 2025, and I'll review that in a second. The other thing they did, though, is they actually increased the band of money in these tax brackets. So as an example, if you look at that 24% tax bracket, married couples now between 171,051 and 326,600 are at 24%. So they lowered the actual percentage of taxes, and they increase the amount of money you can make. So do you consider that an opportunity? How much time do you have for that opportunity? Well, again, the Tax Cut and Jobs Act of December 2017 was enacted, and it cut individual tax rates, doubled the standard deductions, as we'd mentioned, and eliminate personal exemptions, and lowered that TOPS rate to 37%. Also lowered the corporate taxes from 35 to 21, as I had mentioned. Here's the interesting thing that I highlighted in red. The corporate tax cuts are permanent, while the individual changes expire at the end of 2025. So what does permanent mean? Again, if you get the House, the Senate, and the presidency to overturn it, any law can be overturned. But right now, with a 50-50 Senate, that's going to be a tough one. Otherwise, that one is permanent until someone comes along and changes it. The individual, though, for all of us, expire in 2025, and they were grandfathered into the tax law to sunset. And so you do have to be aware that those lower numbers will go back to the old numbers or higher, depending on what the presidency and the Congress would like to do in 2025. So the easiest way to raise your taxes in 4 years, is just let the new law sunset and go back to the old numbers. So be aware again, if the votes are there, the law can be overturned at any time. Okay, now let's talk briefly about something that most people understand, and it's called the required minimum distribution system. The question I have for you is, did you know this is a growing story or a growing proposition? Now, this is actually converted into percentages, and you'll see here, there's the ages of 72 all the way down to 92, and you'll see the percentages that you're required to take out of these tax-deferred accounts, IRAs, 401ks, SEPs, simples, anything that you have tax-deferred. Now, when I sit with people, most people know that, yeah, I have to take out about 4% when I start this process. But did you know as you get older, the percentage goes substantially higher? So if you look at age 80, it's up to 5.35, 85 is 6.7, age 90, 8.78. The reason that's really important, I'm going to give you an example here, is what if I had $1 million and at age 72, I needed that 3.91% to live in retirement? So in essence, that's $39,000. You would ask yourself, did you figure that out right? And the answer is no, because that money has to be taxed. Now you want to figure out what your tax bracket will be to figure out how much you really have to take out. The flip side of that is if I didn't need $39,000 of this tax-deferred money at age 72, what did I wait so long for? Why did I wait so long to cross the bridge? First thing you want to figure out, how is your money taxed? And that really depends. There are different ways that you can be taxed, from tax-deferred to taxable and tax-free. You have to determine what your tax picture will be in retirement and how this can actually affect you. And I'm going to give you some examples in a moment. What can you do to address your tax situation, and how can you get close to a tax-free retirement? Let's go over some of these concepts here. Now, for the first portion of the presentation, to keep it really simple, because a lot of that was rather dense, I asked people, if you had $1 million in your 401k, number one, who is your partner, and how much is yours, and how much are your partners? It really depends on when you take it out. So what I'm trying to help you understand here is, so many people look at these tax-deferred accounts, and in this case, $1 million, and think it's worth $1 million, and I assure you it's not. You'll find out when you start taking the money out, and you want to do that in the most tax-efficient manner. How do you determine how this may influence your retirement? Well, it goes back to something we have called the bucket strategy for well over 30 years. So here's the tax effect on your savings. Here's that tax-deferred, here's that taxable, and here's the tax-free bucket. Here's a couple of examples of tax-deferred money. Workplace retirement plans, 401k, 403b, 457, TSP, IRAs. Most annuities are tax-deferred. Taxable, interest and dividends. Annuity gains are taxable. Pensions are taxable. Social Security, you didn't know this, up to 85% of your Social Security benefit can be taxed on the federal level. And depending on your income, the state could also tax a portion of it. Brokerage accounts are taxable, and your salary is taxable. For everyone who wants to get in tax-free, you have to wonder, why are there only 3 items in the tax-free bucket? Most people I sit with have less than 10 or 15% of their money in tax-free, but they all want to be there. That's the Roth IRA, municipal bonds, and sometimes cash value life insurance. And you'll see an asterisk there with good reason. You have to know how to take money out of life insurance for it to be truly tax-free. So let's go over a case study here. And so first we have the Joneses. They're 50 years old. They'd like to retire in 15 years at age 65, reduce taxes if possible now and in the future. And they really wanted to leave a legacy for their child, which was kind of nice. The assets were $500,000 of tax-deferred money, $100,000 in a taxable account, a 401k they were putting 10% a year into, and the household income was $100,000. Now, The insurance concerns, they had a long-term care policy for $4,000 a year. I've been a certified long-term care specialist for over 20 years. I know quite a bit about it. Their policy that they had, there were some concepts that I thought they would do better with. This was an annual pay policy, and they were a little frustrated with the increasing cost annually of long-term care. They also had term life insurance. I'm a big advocate of life insurance if it's needed in the household, but the term policy was going to expire and they didn't know what to do from there. Legacy plans, they had none to date. So here's the beginning of the case study. And in essence, what I'm trying to get to you, across to you today, back to that tax bridge is, if you were a farmer, did you want to pay the tax on the seed when you purchase it or the harvest? And most people say the seed. So let's take a look at the seed in this case. Here's $500,000 of tax-deferred money, and they had said to me they would like to make 7% a year over the next 20 years. And so when we took a look at the potential growth of that money, they were looking at the harvest of $1,934,000 of tax-deferred money. And that's the concept of crossing the bridge sooner or later. Now, there are some considerations. It's not as simple as I'm stating. The other thing we want to look at as retirement planners is, what type of required minimum distribution would that be if that money really did grow to that level? And my answer was $73,534. And when I did the retirement analysis, the distribution was far greater of what the future cash flow needs would be. So not a great concept to allow this to grow way up then. One of the options you have is Roth Conversion. And let me just state this quickly here. Most people feel if they're not working, they cannot do a Roth Conversion. That is not accurate. You cannot contribute to any type of retirement account, such as an IRA or a Roth, if you don't have earned income. That's a contribution. But the conversion of taking money and crossing that tax bridge again to a Roth is called a conversion. So tax-deferred money to Roth, you can do even if you're not working. Now, it allows you to shift money from tax-deferred to tax-free, pays taxes at the current rate. So let's assume they were in this 30% tax bracket. What would be the tax bill if I suggested they convert $500,000 immediately? Well, it would cost them $150,000, and that would not be a really good tax strategy. The other question that may come up is, hey, Mike, can they even convert any money? Because they're only 50 years old, and I thought there was this rule of being 59 and a half before I can touch my retirement account. So along comes the IRS to help you out with that, and this is called a 72T distribution code. And let me show you how it works. It allows you to take equal and annual distributions from IRAs before the age of 59 and a half. You would still pay taxes, but you would not pay that 10% penalty. However, the distributions have to go on for at least 5 years or the age of 59 and a half, whichever is greater. So you can't start this just 1 year and decide you're not going to do it any longer. Otherwise, that initial distribution would be subject to the penalty. Currently, a 50-year-old can take out about 5% a year utilizing this strategy. What the presentation is designed to help you visualize and grasp is, it's called Recapturing Money, to go from one of those taxable or tax-deferred buckets to the tax-free bucket. And here's how we did it in this case. So of that $500,000 tax-deferred IRA money, even though they're 50 years old, we're going to start taking out that 5%, $25,000 a year. We're going to start liquidating that taxable brokerage account of $10,000 a year, subject to some capital gains. We're going to stop putting money into the 401k, and the reason being is they were not getting a matching contribution from their employer. So in essence, all they were really doing is tax deferring. And then we're going to discontinue the term life and the long-term care only because the solution that we found for them was a better option for them. And I'll show you how we did that. So what we're doing here, excuse me, is we're recapturing $47,000 a year, of which $35,000 is taxed as ordinary income. So let's go to that hypothetical 30% tax. So now we're moving $36,500 a year to this tax-free bucket strategically because we're cognizant of their progressive tax rate and we don't really want to put them in substantially higher tax brackets. So the concept of converting the whole $500,000, this is what we did in lieu of that. Now, step one here was a Roth conversion. And if you didn't know this, after 59.5 or 5 years, all distributions are 100% tax-free. Distributions from this account do not cause your Social Security to be taxed. Remember, I did say up to 85% of your Social Security can be taxed. The contribution limits are $6,000 and $7,000. And if you need income in retirement, the Roth would provide tax-free income. So we did $14,000 of that $36,500. Step two in this case, very specific to this case, we purchased a cash value life insurance plan with a long-term care rider, which are becoming very popular in the marketplace. Now here, no age restrictions. All distributions are 100% tax-free. Again, with the asterisk, if done properly. Distributions from here do not cause your Social Security to be taxed as well. This policy also added $10,000 a month in long-term care benefits. So that's how we were able to save that $4,000 a year of ongoing increasing long-term care premium. And this one here is estimated based on that 7% hypothetical rate of return to generate about $65,000 a year of tax-free income, as opposed to that $73,000 estimated required minimum distribution, which was taxable. And this also addressed their legacy. And so you'll see how we were able to also get rid of that term life insurance and put in something permanent in place. So of the $36,500, $22,500 went into this plan. How does this plan actually work? So you'll see here that that premium created a very substantial death benefit, almost $1.6 million. So again, that's how we got rid of the term life insurance, and it produced $10,000 a month of long-term care benefits. So it had two facets that helped us design this plan. Again, what and how this is not important for the conversation tonight, but you'll see the $23,500 going into this plan for 15 years. The reason 15 years is, if you remember, they wanted to retire at 65, and we also were able to finish off the conversions by age 65. You'll see here, based on that hypothetical 7% rate of return that they were hoping to get, this now has the capability to pay out a little over $65,000 a year, tax-free, all while maintaining cash value and a death benefit, which was important for their legacy considerations. Now, when we did a comparison with our tax software, you'll see if they stay in this hypothetical 30% tax bracket, for a 50-year-old couple, they're doing pretty good. Their money looks like it would run out at about age 85. Unfortunately, if the taxes went higher, let's say 50%, the money would only last till age 78. And by embracing that seed versus the harvest and getting into tax-free, not only will the money last out to age 100, but they would leave a substantial legacy of $1.4 million. So in essence, what we're able to accomplish here was tax-free money into the Roth bucket, tax-free into the cash value life insurance, eliminating all the taxes from the IRA, from the conversions, and getting to tax-free on Social Security. Now, this case is, the numbers are a little large, so certainly don't be alarmed at the size of the numbers here. I wanted to show you the effect of taxes on retirement. What we're going to do is we're going to compare two scenarios here. On the left-hand side, you're going to see a hypothetical 4% rate of return on someone's money. We're going to expect 2% inflation on the expenses. And the first case we're going to look at, there's $1,798,000 of tax-deferred money and $195,000 in a taxable account. We're going to compare that to everything being identical, except you'll see the third line item, $1.47 million of tax-free money due to conversions. So let's see how that stacks up. Now you'll notice here, the plans start off on the top right in 2022 with $2,129,000, of which over 90% of this money is tax deferred. You'll see in the left-hand column there, I highlighted starting age 72, the required minimum distribution plan. Now my software has a built-in tax calculator that's not only figuring out the distributions, it's figuring out the tax effect of money here. And so what you're seeing here is if we go across the first year, 2022, you'll see they're 66 and 65. We plugged in their Social Security of $4,042, and their expenses are very high, $8,388. It shows me their net monthly cash flow of negative $43.46. So the first thing this couple would want to consider is how are they generating $4,300 a month? Now the next column I highlighted that shows those small percentages, 0.98, then it goes to 1.7. This shows me that the 4% growth on the money is not good enough, and so you will see the assets in the far right-hand column going down. The reason being is that's the year the required minimum distributions start and the profound effect of the taxes on the money. So all things being equal, if they averaged 4%, you'll see that in essence at age 94 and 93, the plan does what we call redline, it runs out of money. Now I caution you that one of the challenges with retirement software is we're only allowed to show a static return. So hypothetically, anyone making 4% every year is probably an impossibility. But we're not allowed to show the ups and downs of market. So in this case, we chose a very conservative 4% rate of return. So pretty profound. A couple starts with $2 million and potentially runs out of money at age 94. Now remember that top right number, 2129 of tax deferred money, $2,129,000. Now let's compare it to the tax-free model. And now it says they're starting with $1,755,000 of tax-free money. This plan is starting with $400,000 less. I changed none of the parameters. You'll see in 2022, the Social Security is the same, the net monthly expenses are the same, the negative monthly cash flow. But guess what happens here? At age 94, where the prior plan, which was tax heavy, technically ran out of money, this plan still has $1,124,000. And this is the effect of tax deferred money later on in retirement. So starting with less money, but washing the taxes out and crossing the bridge, much more effective here. Let's take a look at a simpler study here of compounding tax deferred versus tax free, because those numbers and that chart can be a little intimidating if you've never seen that type of analysis. Here's an IRA that's yielding 4%. There's $100,000 in it. And when we calculate 20 years of total required minimum distribution, you'll see the distribution, because of that increasing distribution I talked about, they've had to take $101,587 out of the account. At the time of death, age 90, there's $73,651 left in the account. And so in essence, that IRA was technically worth $175,000. If we took out 25% in taxes, you'll see that in essence, that $100,000, remember I said, when you take it out, we can figure out what it's worth. That $100,000 net was worth $131,428. Money coming out of here would tax your Social Security. And because it's an IRA, we labeled it as market risk. Now, you'll see how old this chart is because this is depicting a municipal bond yielding 4%, which is impossible to find nowadays. Now, a municipal bond is tax-free federally, and if you buy the state bonds, they're state tax-free. Here's the same original $100,000. Let's pay on the seed. Let's take the tax right out of the front, the 25%. And so now we have an investment of $75,000 that's going to compound tax-free forever. The end result in 20 years, compounding 4% interest, $164,334, and there's no taxation on your Social Security from here. So in a simple $100,000 example, you'll see the net result of an IRA, allowing it to pay on the harvest, $131,428, paying the taxes up front, $164. So again, no comparison. This was an interesting case that I did for a couple that had substantial pensions and felt that the RMDs, believe it or not, would be a financial burden, and they wanted to do something for their 3 kids. So again, a lot of numbers going on here. You'll see that this couple contributed $15,000 a year to this policy to create a legacy, but also have control of the asset. So you'll see there was an accumulation value or a cash value, so it was not a great growth vehicle by any means, but they wanted to know if they needed this at some point, it would be there, and that's the accumulation value. But more importantly, you see the death benefit here, and this is a policy that had an increasing death benefit. Let's compare that. So let's just say we took that $15,000 a year, we compounded it at 5% for 10 years. Well, the value would be $244,334, of which a good portion would be taxable. And if we did that for 20 years, $397. How does that compare to the death benefit? Well, in 10 years, $343,064 compared to the $244, so $100,000 gain. And even over 20 years, if you can find an investment that guaranteed 5% on the left-hand side, which again is impossible, well, over this policy's life of 20 years, $425,000. So the tax-free legacy concepts exist out there through guaranteed means, if that's something important to you. I apologize on this one. I do have to bypass this one because I do need to make some additional corrections there. So as a summary here, if you think tax rates will be lower in the future, then quite honestly, saving today on a pre-tax basis, such as traditional IRAs or employer-sponsored retirement plans, kind of makes a lot of sense. However, if you think tax rates will be higher in the future, then you may want to consider a tax-free retirement strategy using instruments such as Roth IRAs, permanent life insurance, or even municipal bonds. The concept of once you've had your enough is established, Mike, I'm convinced I have more than enough. Well, then how do you use the tax breaks to reduce your tax burden significantly? As I mentioned to Amanda, I would put this up and leave this up for a minute, and then I will be happy to come back for questions. We hope that you found the information tonight useful in navigating your retirement future. Certainly, if you're a do-it-yourself or self-managed individual, for attending the event, as I mentioned, I will drop the handoffs down to the Darien Library if you'd like to take advantage. There are some great tax articles in there, as well as information on me and my company. If you would like to call me directly, the phone number is 860-430-2138. My email is probably one of the longest you've ever seen. It's michael@usafinancialandtaxservices.com. And something that we have used recently quite extensively, and it has become very popular, is this site below, which is called Calendly, CALENDY.com/finance and tax. And if you do go to that site, you will see a blank version of my calendar with open time slots where if you'd like to reach out to me and schedule a meeting, you're welcome to do that at your convenience. Once you complete that, I would get an email notification. So these are the most common ways to contact me. I am going to come back to the screen now and hopefully answer some questions. And I believe Amanda is going to open up the chat box. And there she is.
Hello. Thank you so much. I really appreciate your time tonight. I don't know if I'm more relaxed or more overwhelmed with what I should be doing with my retirement.
Oh, it is so hard in less, about an hour to give the details that really go into this. And my goal always is, even with this one, which again I think is pretty dense, is to give people as much information as I can in an hour, because the odds of seeing all these people are very slim. So hopefully we're able to give back quite a bit of information. And I know you're going to record it. Hopefully it comes out well, that people can view it as well.
Thank you. Does anyone have any questions? Should all speak at once. Do you have any, a few words of wisdom before you leave us?
Yeah, I do. This presentation, it's funny because financial advisors, and again, that's the construction of the company, they're so eager to talk about investments, rate of return, but the concept of this presentation and one of the divisions of the company is taxes can play a major, major role. And it's funny because for all the people that came on the call, everybody's least favorite topics are going to the dentist and talking about taxes. Oh, there's one. Oh, okay. So someone actually said thank you. Thank you for attending. But you have to consider, when you're doing your overall retirement analysis, what taxes, what type of role they do play in it. And there are ways to mitigate and minimize your exposure in the short and long term. And that's kind of one of the facets of the company that have earmarked. So, back to that last slide. Once you've figured out you're enough, in other words, solvency, the number one concern for retirees or pre-retirees is, do I have enough money? And once you have figured out the solvency of your plan or anyone's plan, then the next question is, how do we mitigate and improve that tax picture? Because again, rate of return is subjective anyway for any advisor. And so what we focus on is taking a much more holistic approach to what you have, what your expenditures are. We look into medical emergency, additional things that are not factored into retirement. And once we see the solvency of that, then we focus on the tax efficiency of it. So we basically always start with a simplistic version of a retirement analysis, which you saw, and then we build in the tax strategies and tax efficiency.
Thank you.
You're welcome. And I know it is overwhelming. As I mentioned, I sometimes apologize for the presentation. I did this funny story for the folks that are still on the call. I did this at a brewery in Monroe the other night. Here's the funny part of the story. I usually get there a half hour early, and I got there 5 minutes late because I forgot my projector. And when I walked in the room was full, and you could hear a pin drop. And I walked in and I said to the crowd, hey, did you ever hear the joke about the advisor who forgot his projector? And they laughed. And it was funny because when I started the presentation, I said, look how many people are here to talk about taxes. And so what you said, Amanda, words of wisdom is, don't sell yourself short when you're figuring out your future and your retirement. Taxes will play a major role. And I assure you, I subscribe to the Warren Buffett theory, particularly when it comes to taxes. I don't know when I'm going to be right, but I assure you I'm going to be right. We have a big problem in this country in terms of spending and borrowing, and it has to stop. And if they raise the rates on all of us over time by 10, 15, or 20%, it could change your outlook on how successful you thought your plan might be.
Thank you. I really appreciate your time this evening. I'll be emailing you, that's for sure.
Okay. Thanks, Amanda, and thank you everyone for attending the call.
Thank you.
Have a great night, everyone.
Take care.